almost we have covered 10 accounting concepts, and now we will start new accounting concept. So today we will be discussing about materiality concept. So you might have heard about materiality concept. So quickly, what I will do, I will give you the idea first, and then we will discuss about the example. So what materiality concept says that we should record only material transaction in books of accounts. Record only material transactions in financial statement. Now you might be thinking that what is material transaction, right? So I will take one small example and we will take multiple examples to understand this particular transaction. Now let's suppose what company is doing. Company is buying two assets. First asset is computer and second asset is, let's suppose company has purchased one notebook, right? Company has purchased one notebook. Now, if I talk about computer, so what adjustment you will provide for computer? Let's suppose cost of computer is 70,000 rupees, right? Now, what adjustment you provide for computer? So definitely you will say it should be recorded as an asset. Definitely it should be recorded as a. Why it should be recorded as an asset? Because this asset will provide you future economic benefit, plus it will be used for more than 1 year. Right? Definitely it should be recorded as a as in balance sheet, right? So what you will do, you will record this computer in balance sheet. If I talk about this another item, that is notebook. We have, let's suppose the cost of this notebook 500 rupees. Now what adjustment you should provide, right? Let's suppose there are 1,000 pages, thousands in this notebook, and what we can do, we can use this notebook for 3 years. We know that we will be able to use notebook for 3 years. Right? Now you will say that, sir, previously there were no computers. So what accountant used to do? They used to write everything in notebook. So notebook is like a computer. Notebook is an ancient time computer, right? So definitely it will be providing you future benefit, right? And let's suppose here life of notebook is greater than 1 year. Let's suppose it is 3 years. Now what you will say that, sir, it should be recorded as an asset, right? And correct that it can be recorded as an asset. But what materiality concept says, materiality concept tries to easy the work of accountant, right? It tries to easy the work of managers or analysts also. Says that you have to record only those transactions which you think is material to be shown in balance sheet or in financial statement, right? Now here, if this amount is very less, this 500 amount is very less. If you're showing this amount in sheet, so what you will be doing every year, you will be charging depreciation on this debt. Right? Definitely, if you're showing it as asset, so you will be charging depreciation. Now, accountant work will increase. Accountant work will increase. Let's suppose accountant has purchased one calculator. Let us assume this is calculator. Cost of this calculator is 200 rupees. If he is recording that calculator in balance sheet, it will is the work of accountant. He has to charge depreciation every year and his number of transactions will increase. So what materiality concept says that if it is not that much material, right? So what you can do, you can directly record this as an expense instead of asset in balance sheet, right? So what you will do, you will record this notebook as a stationary expense in P&L account, and you will write off this whole expense in first year itself, right? Now you might be thinking that who will decide that we have to transfer this book amount in P&L account and computer amount in balance sheet? This material decision is going to be taken by the management, right? It depends how big is organization, right? So if the turnover of organization is 100 crore or 200 crore, then simply what you can do, you can write off this expenditure in P&L account. So this whole decision of materiality is going to be decided by the management, right? Sometimes what managers do, they give 10 rupees or 15 rupees tip to the waiter. They went for business dinner, right? And they have spent, let's suppose, 5,000 for a dinner, and they have given 20 tip to the waiter or to some other guy, right? Now, what expense they should record according to you? They should record 5,020 rupees in their P&L account as a business expense. But now you just think that they have given tip. Is it material to record that expense in P&L account? Definitely, right? Sometimes they pay parking charges, right? So it depends upon management that how they are deciding whether any transaction is material or not, right? So we will read this example and we will this theory. Materiality principle permits other concepts to be ignored if the effect is not considered material. The principle is an exception to full disclosure principle. According to the materiality principle, all the items have significant economic effect on the business of entities should be disclosed in the financial statement, and any insignificant item which will not increase the work of accountant but will not be relevant to the user's needs should not be disclosed in the statement. Right? So if you are giving tip to the waiter, you can ignore that particular transaction. Right? So term materiality is subjective term, right? There is no specific definition for materiality. It depends on judgment, common sense, and discretion of the accountant that which item is material and which is not. Right? So you can read it from this notes and you will be able to understand. Thank you.